Question number 3, how much can I afford? Now this is a very broad question because when we get this question, we usually don't have any information.
So question number 4, how much did you save for a down payment? So there's a couple different things that are important to consider when asking this question.
All right guys, question number 7, how do you lock in your interest rate? This is a loaded question. I'm gonna talk about 2 factors. First is being a pre-approval locked in interest rate. The second way to lock in a rate is, as I said previously, is get a fixed rate mortgage.
And the last question we have is, how long does it take to close on my mortgage? This is a great question.
What is up, YouTube? Today's video, we're going to be talking about the most common real estate investor questions when it comes to mortgages. So I'm really excited to have Josh and Aaron back on the YouTube channel from the Findlay Mortgage Team, and you guys can jump over after this video. They'll literally be live answering your questions. But first, let's jump into the top questions around mortgages.
Thanks for the introduction, Matt. Today we wanted to talk to you guys about some of the top mortgage questions that we get on a daily basis. So we're going to start off with number 1, which is how do you qualify for a loan? We've been through this a few times on Matt's channel, but basically qualifying for a loan has a handful of different variables involved. The first being a consultation. Your goals, your debt servicing, your credit. We take all these factors into consideration when trying to qualify you for a loan. It's really going to depend on a handful of different factors. A lot of it has to do with your total income and your total debt load. From there, we can kind of figure out exactly how much you can refinance or how much you can purchase.
Great. So question number 2 is, what is the difference between being pre-approved and pre-qualified? And it's a pretty important distinction. So a pre-qualification is simply just a snapshot of your financial situation at that current time. There is no validation of your employment. There is no credit check, and there is typically no application taken, just a ratio of what your income is to what your typical payments would be for that property. Now, a pre-approval requires a few more steps in a pre-qualification. You will need a full application taken. There will definitely be some income documents taken as well too for the mortgage agent to validate your income. There will be also probably a credit check done as well too, just to ensure that we're able to use the lender that we've submitted that pre-approval for. Once we submit that pre-approval into a lender, they're actually going to give us a 120-day rate lock commitment. So that commitment just states that as long as your income and the information that we sent in is accurate, you are pre-approved for a rate. The rate that they give you on the temporary commitment is a little bit higher than what your actual rate is going to be. But the main point there is that you have that rate locked down. And then it's going to be, so some pre-approvals in the past were underwritten by the underwriters from the lenders. But now with COVID, some changes have been made and they're no longer doing underwriting on their behalf. So it's important that us as mortgage agents, we underwrite your deals beforehand to ensure everything is accurate.
Yeah, question number 3, how much can I afford? Now this is a very broad question because when we get this question, we usually don't have any information. So there's two basic ratios that we look at when it comes to qualifying for a mortgage. First is your GDS, which is your gross debt service ratio. This ratio takes into account all the costs of your home. It's going to take into account your mortgage payment, your property tax payment, and your heat allowance. Depending on your credit score, if it's above 680, you can go to 39% on your gross debt service ratio. If it's below 680, you can go to 35% on your gross debt service ratio. The second ratio we take a look at is something called your total debt service ratio. This ratio takes into account all of the things I just spoke about the cost of your home. It also takes into effect all the other outside debts you have outside of your home. It's going to take into account your car payment, your line of credit payment, your credit card payments, your student loans. This can only be 44% of your total gross household income if your credit score is above 680. If it's below 680, it can only be 42%. So we take a handful of different variables into consideration, such as your credit score and your income, to be able to come up with that qualification guideline. But in a nutshell, that's how we come up with how much home you guys can afford.
So question number 4, how much did you save for a down payment? So there's a couple different things that are important to consider when asking this question. For the first part, is it going to be an insured mortgage? If the property is going to be purchased with mortgage insurance, there's 2 different down payment rules that you have to follow. A 1 to 2 unit property can be purchased with a 5% down payment, and then a 3 to 4 unit can be purchased with as little as 10% down. So a couple important factors there. There are 3 different insurance companies in Canada. The first one is CMHC, the second one is Genworth, and then the third one is the Canada Guarantee Company. Now, the rule of thumb is typically any down payment under 20% is an insured mortgage. And then once you get into that 20% and above range, you're no longer in an insured product and it becomes an uninsured mortgage. Now, once we go past this 20% mark, we are able to get a little more creative. So for example, we can extend the amortization out from 25 to 30 and sometimes even 35 years, depending if it's a B lender. And this extension of the amortization can actually help to minimize your monthly payments and help to qualify with your debt servicing ratios. In terms of the down payments, the most important questions to ask is where are these funds coming from? Depending on what type of purchase you're looking to do, you are restricted as to where those funds can come from for your down payment.
It's important to note that for the multifamily properties, they do need to be owner occupied. So for the duplex, triplex, and fourplex, to be able to take on that CMHC or that Genworth premium, they have to be owner occupied.
Yep.
All right, guys, question number 5. How do you know what mortgage option is right for you? There's 2 types of options we're going to talk about today. The first is a fixed rate mortgage. The second is a variable rate mortgage. Fixed rate mortgages are based off of the bond yields. So the banks lend money based off of that specific metric. In regards to a variable rate interest, it's exactly as it sounds. So your mortgage payment is actually going to change depending on what prime rate is. So if the prime rate goes up, then your mortgage payment goes up and it goes down. So as you know, markets ebb and flow depending on how the market is doing or economic factors are doing. Usually a variable rate mortgage is cheaper than a fixed rate mortgage and more enticing for most borrowers. It does cause a little bit of uncertainty in regards to your mortgage payment and could change depending on economic factors.
All right, so the next question is going to be, how do interest rates affect your mortgage? Now, it's important to kind of understand that your interest rate will change based off the length of term. So for the banks, the lowest rate that they're going to offer is typically on a 5-year rate on the AAA side, more specifically. So as you start to decrease in your term, the lender is obviously going to be holding on to your mortgage for less amount of time. So the rate does tend to increase just to help offset that length of time. Now on the B side, it does actually change a little bit, where the 5-year rate can actually be one of the more expensive rates that lender can offer, where the 1-year rate typically is one of the lowest rates that the B lenders have to offer. So again, it depends on the length of term that you're looking for as well too. The more important part in terms of interest rate isn't exactly the interest rate itself. It's more about what does that product bring for you. So some important things to consider are, is it a fixed or variable rate, which Josh just talked about? What kind of interest penalties come with those types of terms? So these are some very important things to kind of consider a little bit more opposed to than just what is my interest rate.
All right, guys, question number 7. How do you lock in your interest rate? This is a loaded question. I'm going to talk about 2 factors. First is being a pre-approval locked-in interest rate. That pre-approval locked-in interest rate is usually good for 120 days. A lender will lock in that rate, so you have the ability to go purchase a property in that time without the interest rate going above what they've quoted you. The second way to lock in a rate is, as I said previously, is get a fixed rate mortgage. If you lock in your rate with a fixed rate mortgage, your interest rate is going to stay the same throughout the term of your mortgage.
Perfect. So question number 8. What does your mortgage payment include? This is a great question. There's 2 types of mortgage payments that we're going to talk about here. The first one is going to be a conventional mortgage, where you're going to have a principal and interest payment. So just like that, your mortgage payment consists of a principal payment, which those payments are going to pay directly down on the principal amount that you have borrowed from the lender. And then the other portion is going to be your interest portion. Now this is going to be the interest charge based on your interest rate of the term. Another thing to consider is that some lenders may actually include your property tax payments in with those mortgage payments. So that means that the lender will be collecting your property taxes payments from you and paying them on your behalf. Something else that can be included in your mortgage payment could be your CMHC fee. If it's an insured mortgage, you will have an insurance premium that you will be paying along with your mortgage payments. Now, one other thing to consider too is if you're in a private mortgage, there is no principal payment. So you're not paying anything directly down towards the principal amount. You're strictly just paying the interest off on that mortgage.
All right, guys, question number 9. When should I consider refinancing? Well, there's a handful of situations when you would, and basically it's up to you. But if you can basically so if there's a lower rate in the market, A lot of people want to take advantage of that lower rate to save money over the term of their loan or over time as they pay down their loan. So one of the things to consider is, does it make sense for me to be able to lock into a lower rate compared to the cost of actually refinancing your home? I think you have to make an analysis as to the upfront cost to do it and the amount over time that you would save by changing your interest rate. The second is, do I have enough equity to refinance? That's a great question. So what most lenders look for in a principal residence is at least 80% loan to value on a loan. So if you have, say, 70% of the value of your home in a first mortgage and you want to tap into that extra 10%, you will have enough money to be able to do that. It is important to factor in the cost associated with that before making that decision. The last would be opportunity cost. A lot of people who are coming to us are investors who want to use the equity in their home as a tool to be able to grow their portfolio. Does the cost of doing that transaction equate to the opportunity cost, either lost or realized? So I mean, a lot of people are making decisions based off that, and a lot of people are finding that they can make their money work for them at a much higher interest rate than, you know, the 1.98% that you can get right now in the market. A few different things that somebody might use a refinance for: debt consolidation, pay off those high interest credit cards, get into a low rate product. Second is going to be investments. Do you want to put it into stocks, bonds, mutual funds, a REIT, stuff like that? Or the third is going to be renovations. Do you want to do some renos to your house and to force appreciate that value of your property?
And the last question we have is, how long does it take to close on my mortgage? This is a great question. The time that it takes to close sometimes depends on the type of lender. So a AAA bank, from the initial process, that pre-approval stage and getting your approval, so the approval itself can sometimes take 24 hours to 48 hours, depending on how busy it is with the underwriters at the lenders. Now, on the busier times of the year, sometimes we may see a turnaround time from 48 to 72 hours for that actual approval from the lenders. So, you know, if you have any conditions of financing that you're considering, make sure you check with your mortgage agent to see, you know, how busy that particular lender's underwriters are and what kind of time frame you should have on that condition. Now, from the time of getting that actual approval and getting your commitment to time of funding, some lenders probably will want to see the time to be 12 to 15 days to getting the broker complete. So that broker complete phase is going to be when all the conditions have been satisfied from the mortgage agent standpoint. So all documents have been validated and you're now off to the solicitor conditions and the actual closing. Now, the other type of mortgage to consider too is if you're looking for a private mortgage. Private mortgages can essentially close as fast as the lawyer can work. We've had some emergency situations where buyers have come to us and had some financing that's fallen through and needed to close on their property. We've been able to turn around private mortgages in as little as a couple days, and that's one of the benefits of you know, working with us when we create a lot of our personal networks with our private lenders. If we have a deal that we really need to push through the door, we can get that deal done in a couple days. So again, time on closing depends. You're looking at, you know, about 15 days on the A side or a traditional bank type lender, and then, you know, as little as a few days for a private mortgage. So that's it for this day's topic. Now, if you guys have any more questions or want to chat with us a little bit further, you can actually hop on over and watch our live stream. We'll be live for about an hour to answer, like I said, any of your questions or further comments. So make sure you hop on over and engage with us there.
All right, thanks to Josh and Ehren for answering your most common questions when it comes to mortgages. And as a reminder, they're live literally right now as you're watching this, answering your real estate questions when it comes to mortgages. So jump over to the Findlay Mortgage Team's YouTube channel, hit them up with your questions, and let us know in our comment section down below, do you want to see this partnership continue? Should we make this a thing for every single Friday going forward? And otherwise, just smash that like button, hit the subscribe button if you're new to my channel. I'll see you in the next video.